Progress. Alrighty, so day 4. Today we're gonna start off by talking about my slides would load. Perfect. The classification of the population. So in economics, the population is broken down into these categories. First, you have the working age population and not in the working age population. You're counted in the working age population if you're above 16, not in jail, not in the military, not in critical care, and are not retired. And so people in the working age population are split into the labor force and people that are not in the labor force. And so you're not in the labor force if you're not a discouraged worker, if you are a discouraged worker, or if you're a student and you're not working. And the labor force is finally broken down into the employed and the unemployed. You're considered employed if you have worked an hour for pay in the past week, or 15 hours if you are working unpaid. And you're also considered employed if you're on vacation or sick leave. You'll be considered unemployed if you don't have work and have attempted to find a job within the last 4 weeks. Unemployment. The Bureau of Labor Statistics, the BLS, measures the unemployment rate monthly. The unemployment rate is basically the unemployed divided by the labor force. And so, on the other hand, employment rate is the employed divided by the labor force. The labor force participation rate is the labor force divided by the working age population. Please note that the unemployment rate differs across race, gender, and age groups. So for example, teens have a higher rate of unemployment because that's when teens start to join in the workforce. In economics, or at least in AP Macro Econ, and in this class, we will only consider 4 types of unemployment: frictional, structural, cyclical, and seasonal. To start off with frictional unemployment. Frictional unemployment are caused by people that are entering the labor force or people that are voluntarily quitting to look for better jobs. You can also be considered frictionally unemployed if your company fires you to find a better worker. Frictional unemployment, the length of it is determined by unemployment benefits. So the better unemployment benefits you have, the longer your frictional unemployment will be. Frictional unemployment is a healthy sign of the economy because it means the people and the workforce are looking for better jobs and better workers. And now structural unemployment. Structural unemployment is caused when you don't have a certain set of skills that are needed for the workplace. Usually this occurs to people who work at jobs that have been replaced by technology, or your job has been offshored because the labor elsewhere is much cheaper. Those that are structurally unemployed face a really hard time because in order to get employed again, either A, they have to move out of where they live, or B, they have to relearn or they have to go learn a new skill so they can adapt to their working environment. Structural unemployment is also a good sign of the economy because it shows that the economy is advancing in terms of its workplace. And some examples of jobs that have become structurally unemployed here in the United States are like switchboard operators or US factory workers. Cyclical unemployment. Cyclical unemployment is just caused by recessions. So if there's a recession and you're laid off, then you're part of that cyclical unemployment. And cyclical unemployment is a bad sign of an unhealthy economy because it's showing that our economy is slowing down and not being as productive as it used to be. And finally, seasonal unemployment. So you're seasonally unemployed if you only work at a job that only employs you for a certain season or a few months. So for example, a ski resort operator, because in the summer, the ski resort will be shut down, and so the operator wouldn't have a job. Don't worry too much about seasonal unemployment. You wouldn't see this in the USAD ACADEC Econ, but we do mention it in AP Macro for like a bit. And now I'm going to talk about the circular flow model. The circular flow model basically shows how money, goods, and resources travel within the economy. So I'm going to start here with the households. Households basically provide um, the factors of production, land, labor, capital, and entrepreneurship to the markets for factors of production. And this is where the firms take these resources to make goods that they place in the markets for goods and services. And at the markets for goods and services, this is where households again buy these goods and services on the market. Um, and also on the market for goods and services, you have exports and imports to the foreign sector, basically other people from outside the country. And now we talk about the flow of money. So households receive wages and income from the factors of production that they provide. So here you see the arrows point to households. And households use the money they get to either pay for goods and services or to pay taxes to the government. And the government, oh, and talking about households, they can also choose to save in the financial market. The government, with their income from taxes, can choose to spend that money on goods and services or save it in the financial markets. And in the financial markets, the firms will demand investments to make purchases of capital equipment. So yeah, that's basically the circular flow model. If you Google circular flow model, you'll see a few different ones with that look slightly different. Like I know some of them, they don't include government or financial markets or the overseas sector, but mostly they tell you the same thing, that households provide factors of production to firms, firms sell households goods and services. And now we talk about real GDP per capita and average labor productivity. So real GDP per capita basically just means the real GDP of a country divided by its population. Per capita literally means per head, if you translate it. And so the real GDP per capita differs across different countries, primarily because of differences in average labor productivity. Average labor productivity is basically a country's real GDP divided by the number of people employed. And average labor productivity is affected by physical capital, human capital, natural resources, technological knowledge, and political and legal environment. And now we talk about the financial system. So in the financial system, savings are when households have their incomes are greater than their consumption. Investment is businesses spending on capital equipment or households buying houses. And so the financial market is basically an institution that allows savers to directly connect to firms such as the bond market or the stock market. And financial intermediaries are third parties that connect savers with investors, such as banks or mutual funds. And the market for savings and investments. This is also sometimes called the market of loanable funds or the market for savings and loans. And so here, the important thing to remember is that the savings supply are from households and government, and the demanders are firms and any household that are buying houses. And so now we talk about saving supplies and the investment demand. So the saving supply basically slopes upwards because as real interest rates rise, suppliers will provide more savings because they can get more back from the loans they provide. And investment demand slopes downwards because as real interest rates rise, demanders will demand less because they have to pay more for the loan that they're borrowing. Right. So factors that shift the savings supply curve: change in tax credits for savings, change in disposable income, buying power of net assets, expected future income, government deficit, and household expenditures. And factors that shift investment demand, the only factor that really shifts investment demand are expected rates of profits. So some factors that would change the expected rate of profits are like business cycles, technological change, population growth, tax rate, and energy prices. And net capital outflow. Net capital outflow is equivalent to the domestic purchase of foreign capital and financial assets, subtract the foreign purchase of domestic assets. There are two types of international capital flows. The first is foreign direct investment, in which a foreign company buys an asset that they will manage actively. And the second is portfolio investment, such as buying a foreign government's bonds or stocks. In an open economy, net capital outflows is equivalent to net exports. And now we talk about money. Money is basically an asset that has three properties. First, it has a store of value, medium of account, or unit of account, and a medium of exchange. So medium of exchange just means that you can use money to trade for other objects. Unit of account is basically the meaning that everything is labeled in terms of money. So, right, if you go to your local supermarket, apples are priced $4. So it's in terms of money and not in terms of other stuff. And finally, store of value basically just means that money can keep its value over time. So if you get $1 today, tomorrow it's still $1. A year from now, it's still $1. And two types of money we will consider here in the ACADEC Econ is fiat money and commodity money. Fiat money is basically money that the government says is money. Commodity money is money that has actual value to it, like gold or like cigarettes. In economics, wealth is basically the sum of all the different stores of value in the economy, such as currency, checking deposits, stocks, and bonds. And please note here that different assets have different liquidity. And liquidity is basically the measure of how easily it is to convert your money for transfers, so to buy different goods and services. And now we talk about the money supply, or in the USAD guide, I believe they use the stock of money. The money supply is basically the total amount of money in the economy. And economists classify money into many different categories, but the most popular are M1 and M2. M1 consists of currency and checking deposits, and M2 consists of M1 and savings deposits. Note that the items in M2 are less liquid than the items in M1. And finally, talking about money supply, note that debit and credit cards are not part of the money supply because they themselves are not money. It is the checking account that they are linked to that has the checking deposits. And so the checking deposits are the money, but not the credit and debit cards. And yeah, that'll be the end of day 4. Does anyone have any questions? Yeah, what's your question, Austin? Yeah, Carlton? Okay, let me repeat that question to Zoom. So basically the question was, how did the Silicon Valley Bank buying of government bonds lead to their crashes? I'm not too sure about this, but I think the reason why they failed was because they made some really risky investments. And so those investments turned out to be quite bad. I'm not too sure about this though, I have to look it up. But I don't think it's government bonds. Government bonds are usually really stable and they're backed by the government. So I don't think it's government bonds that led to the crash of the Silicon Valley Bank. But good question. Anyone else have questions? Vincent, do you have a question on Zoom? Alrighty. All right, well, I guess that's it for today. Thank you guys for listening into the lecture. And Vincent, if you can tell Beverly Hills, we won't have a session until Monday. Thank you. All right.